Welcome to the Real and Real Estate Podcast, your go-to show for real estate success. Whether you're an agent aiming to crush it or a buyer or seller wanting the inside scoop, we're here to deliver expert advice, insider tips, and the real talk you need. Each episode, we chat with top industry pros to give you the facts, strategies, and inspiration you need to thrive in this business. Let's dive in and make big moves together. Hi, welcome back to the Real and Real Estate Podcast, where we talk to the experts and get the facts. And today I'm here with an expert for sure. This is Chad Helmcamp from BWC Lending, who I've known for years and is just an absolute wealth of knowledge. So thanks for joining us again, Chad.
Thanks for having me. I'm happy to be here, Gene.
Well, I'm excited to talk once again about a subject that is very near and dear to everybody's heart, and that's home ownership. And I wanted to give you an opportunity to talk a little bit about interest rates, and then we'll go into another subject that kind of has my interest at heart. So, welcome.
Absolutely. No, happy to be here. Yeah, it's been another wild year to say the least. I'll say this year has been certainly quite a bit more stable than the last several years, which makes it a little bit better when you're trying to buy a home. Um,
Right.
we have had some interest rate volatility, but the good news is that most of the volatility we have seen has benefited home buyers, and we've seen rates sort of trending downward. And so right now, as of last week, the average interest rate on a 30-year fixed rate was in the low sixes, around 6.25%. And over the last several years, when we've had 30-year fixed rates touch 7 and almost 8% at times, 6.25 is feeling a whole lot better.
Very good. Yes, absolutely. Absolutely. Now, I believe the Fed is meeting in the next week or two. Is that correct? To discuss interest rates?
That is correct. Yeah, they are. I think they're meeting next week, as a matter of fact, and the expectation a little more than a week ago, there was only about a 30% chance that we expected a rate cut. And then we had a couple of the different Fed members speak and led people to believe that they may, in fact, cut one more time. And as a result, we saw mortgage rates improve a little bit. Today, rates are ticking up just a little bit due to some comments on the global scale. But right now, there's about a 70 to 80% chance that the Fed will cut the short term interest rates next week. Most of that is believed to have been priced into the market. And so, as I always tell people, if they end up cutting next week, the market seems to expect that to happen. But what's going to be important is, what do they say after that? It's always about, what does Fed Chair Jerome Powell say during his speech? And is he saying, hey, look, we've cut, we're done cutting, and we're going to stay here for a while? If that's the case, we could see mortgage rates tick up a little bit. If he says, hey, the job market is showing signs of weakness, inflation sort of at bay, sort of other words, leaving the door open for more rate cuts, then we could see
Right.
mortgage rates improve further. So, as is always the case, it's not so much what they do, it's what they say after they do it that's important. And that's what we'll be paying attention to.
All right. Well, I hope they cut the rate a little bit, and I hope they watch what they say because that will certainly help our market as well.
Absolutely. Yeah. We definitely could use a little help in the mortgage rate environment. That's for sure.
Now, I don't know one has a crystal ball, but do you expect there to be a continued, not downslide, not a landslide, but continue tick down on the interest rate after the new year? Or is it just too far to predict at this point?
It's always difficult to predict, right? Obviously, I tell people all the
Yeah.
time,
Right.
if my crystal ball was solid, I probably wouldn't be doing this on a daily basis. But most of the experts I follow and most of what I've read sort of leads me to believe that mortgage rates are going to range between the mid fives to the mid sixes for the next several years. And so I think what that means is, I think there will be periods of time where rates dip just below six. They may not last very long. I think we're going to live in kind of the low to mid sixes for the most part. So I think people
Okay.
need to sort of get comfortable budgeting for rates in the sixes. If you get lucky and get rates in the mid to high fives, then great. We have a few clients right now that are locked in sub 6%. They are paying some points to get it below six, but at least we have that option. We haven't really seen those options in the last 4 years, except for brief moments of time. And
Right.
so now it's kind of nice for those people who are looking to buy and can lock something in the high fives.
All right, so let me ask the expert this question. I always say, don't be afraid of the interest rate. It's going to change. If it lowers, you can always refinance. But at what point and how do they know when it's time to refinance? I mean, obviously, if you go from 6.2, 6.1, that's probably not going to save you a lot of money.
Correct. Yeah. The rule of thumb is whatever your interest rate is, you want your interest rate to improve by roughly 1%. So if you're locked
Okay.
in at 6, you'd like it to get to 5. Right now,
Okay.
there's not a lot of people expecting rates to get to 5%. I feel like a lot of people who are buying right now very possibly may never refinance. Of course, something could happen
Okay.
on a global scale that would change that. But right now, if you're getting something in the high fives or low sixes, there's a decent chance you may never end up refinancing. And that's not the end of the world. It's just the state of where we are right now. But 1% is kind of the rule of thumb, but it can depend. The larger the loan, sometimes you don't need to see a full 1% improvement. There's no doubt I have quite a few clients who it really makes sense for them to refinance right now, but in their mind, they believe rates are going to move lower. I'm not sure what it is they're reading that makes them think that. All I can do is provide the information and let them know, when it makes sense. What we try to do is that we do an analysis to show your break even being 24 months or less. In our view, if you're going to break even in less than 2 years and you're going to live in the home 3 or more years, then in that sense, it makes sense to do it.
Makes sense.
Um, Now, one thing I will mention is adjustable rate mortgages are starting to become a bigger part of the conversation. We are definitely seeing more and more people opt to go that route, and that's because the market has normalized a ton as it relates to the yield curve, and so adjustable rate mortgages are showing some nice benefits for some clients.
Can you give us just what numbers are we thinking that is and how long? What is the advantage? Obviously, it must be a lower rate, but it can
Yeah.
fluctuate.
Yeah, and adjustable rate mortgage is just that. It's a rate that can fluctuate, but they're usually fixed for a period of time, 3, 5, 7, or 10 years. I usually look at the 7-year adjustable rate mortgage. Historically, homeowners have moved every 5 to 7 years. I do
Right.
think that average is gonna change a bit now since people are locked into these really low rates, so I think you'll see people staying in their homes a little bit longer, probably 7 to 10 years at least. But a 7-year period does cover a lot of time, and so right now, if a 30-year fixed rate's at 6 and a quarter, you might be able to get a 7-year ARM at 5.75, and that
Okay.
0.5% difference on the rate can be pretty meaningful. And so if you live in that home 5 to 7 years, or if you think you're gonna pay the loan off aggressively, then it could make sense to go that route. So 7-year adjustable rate mortgages are not for everybody, but I do think it can be a nice tool for people or who have maybe they don't expect to live in the home for a very long time, or they're just comfortable with the risk that they're taking on.
So to clarify, just as an example, if I were to do an ARM adjustable rate mortgage at 5.75 for 7 years, then at the end of 7 years, it would adjust to whatever the current rate is. Is that correct?
That's correct. It'll usually be tied to a certain index. One of the most common indexes right now is called the SOFR index, Secured Overnight Finance Rate. And right now that index is around 4%. There's usually a margin on an index, which means the margin is usually 2.75. So if the index is at 4, the margin is 2.75. That means if it were to adjust today, the rate would be 6.75%. And so there you're getting that discount now because of that locked in sort of rate, so to speak. And so if rates stayed flat over the next 7 years, then yes, at the end of year 8, it's possible the rate would go up to 6.75.
So that could potentially help a lot of people that are hesitant about buying a house, actually help them get that house. And as you said, most people are in their home for 5 to 7 years, and we don't have a crystal ball that goes 5 or 7 years. So that sounds like it's a very good possibility for people.
Exactly.
Well, let me talk about something else with you. I hear so many people saying that, young people cannot buy a home right now. And I was just FYI talking to a young man, I think he was around 27 maybe the other day. And he was going, well, I'm renting and I want to buy a house, but I don't think I can do it right now. And I said, well, what are you looking at? And he was talking about for his first home being like a $500,000 home. I don't care what market you're in, that's not a starter home. So I'm wondering if some of this, I mean, obviously, I think it's important to be a homeowner. You're building equity, you're building wealth, you're not paying the landlord's equity, you're building equity for yourself. But I don't know that people are really, how can I say this? He could start out with the $200 condo or townhouse, build his wealth, build his equity, have his own home, and then move on to the next home. And then he either sells the smaller home or he rents it out when he goes to his next home. I think that's a very good way to jump into the market without starting out with your dream home. I mean, some people don't get to their dream home, whatever that is, till like the fifth time they bought a home. So, do you agree with me that maybe some expectations could be too high?
Oh, 100%. I mean, I think, I've always said, I feel like one of the primary thing that we do in our business is we manage expectations, or we attempt to do so anyway.
Mhm.
And yeah, I think the expectations of what people think they're going to get have been skewed for quite some time. And make no mistake about it. I mean, it's like, I don't want to, this past year, I think they said the average first time home buyer's age was 40 years old, which is the highest it's been in decades.
That's yeah, that's a shame actually.
It is a shame. And so, uh, but it doesn't change the fact that, yes, with the fact that rates have gone up as much as they've gone up. And so what I did was I looked at some numbers. And so the average sales price in the Houston and surrounding area in December of 21 was $392,000. That was the average. At that time, the rates were around 3%, and the monthly payment was around $1,600. 1 year later, December of 22, that same home was now 409,000. So it went up almost $20,000 even in a year where rates went up, but the monthly payment went from 1,600 to 2,460. So when you have a payment that's going up about $800 for a very similar home in just 1 year, it's a shock to the system. And it does
Yes.
take time for the market to sort of catch up to that, if you will. And of course, rates at that time were in the sixes, about where they are now. They hadn't really peaked yet. They peaked sort of in 23. We had several times where they sort of peaked. But now they're sort of settling down. They've calmed down a ton, and they're in that low 6% range. And here we are, October of 25. Now the average sales price is 423. So from the end of 21, we're at 392. Now we're at 423. So, around $30,000 worth of appreciation in that 5 year period. And the monthly payment went from 1,600 to about 2,500. So about $900 more for that same home here 5 years later. And so those are real dollars, and I can't
Yes.
discount that for first time home buyers. But what I try to do with every client I meet with is reset that expectation and look at their income, look at their debt to income ratio, and can they afford it? And when I say they afford it, is the monthly housing expense around 30% of their gross monthly income? If it is, then yes, I do truly believe they should be buying a home, because, like you said, the equity building is real, regardless of
Right.
what the monthly payment is. These homes are going to continue to go up in price, in value, over the next 3 to 5 years.
And now time for a short break.
Ready to jumpstart your social media strategy? I'm Katie Lance, and the Get Social Smart Academy is your go to for smarter content planning. Get weekly trainings, Canva templates, and AI tools to save time and grow your business. Go to katielance.com/academy to join us today.
So they're not getting cheaper,
So,
is the point. The monthly payment
right.
is not going to get much cheaper.
No, but that's the median price home also. So that includes everything. I guess my point is maybe you don't need to start out at that price range. Maybe you need to start out a little bit smaller just to get your foot in the door, so to speak. And then the
Absolutely.
wealth you build from that smaller purchase can help you buy the bigger purchase eventually. I mean,
Absolutely.
you need to hold on to a home a minimum of 2 years for tax purposes. But other than that, I think we just need to adjust our expectations. Well, that's what I think.
Yeah.
That's what
No,
I
no,
think.
I agree. And so the numbers I just gave you was the average sales price.
Right.
The median sales price was around 330, and it really hasn't changed a whole lot. So the
Right.
median, meaning half the homes sold for more, half the homes sold for less, which tells you there's a lot of homes out there for 330 or less. And
Right.
that's probably more in that starter home category that you're talking about. And I 100% agree. If you have somebody that can find a home um, that works and they can afford it, then yeah, the sooner they own a home, the better.
Yeah. So, what advice would you give to a first-time home buyer right now, or someone maybe already has a home but wanting to move up? Do you think going the ARM rate? Well, obviously, first of all, they need to talk to a lender. They need to give you a call, find out what they can and can't do, what the advantages and disadvantages are. But it sounds like maybe adjusting expectations and considering an adjustable rate mortgage might be a good way to get in the door, so to speak, literally the
Absolutely.
door.
Yeah. Literally in the door. That's right. Pun intended. Um,
Yes.
Yeah, I think that's the thing. You gotta have that conversation. I think a lot of people assume they can't buy a house, assume that they can't afford it, and I don't think that's fair to themselves or to anyone else. I think they have to talk to an expert, start running some numbers, look at some math, and see if you can make it work for yourself. Um, in this environment we're in with home prices having gone up as much as they have over the last number of years, you know, down payment, income, assets, credit, all of it matters. All of it comes into the mix. And you just got to look at your ingredients and see, do you have the appropriate ingredients in order to be able to buy a home?
And I think it's important, and correct me if I'm wrong. If you're not sure, don't be afraid to talk to a lender. There's nothing you're going to say to you or whomever they want to talk to that you haven't already heard before. So it's not like, well, I don't want to talk to him because my credit score is not high enough or I don't have enough money in the bank. Let them help you, let you help them figure out how to get to where they need to be. And that's not really, again, talk to the expert. Don't assume you know how to get there on your own.
Absolutely. Yeah. I think every time I meet with a client, we walk away from that meeting with a clear plan in place. I had a loan meeting earlier today with a veteran, uh, young guy, first time home buyer. He and his wife are about to have a child and they want to buy a house. And so we went through the application together. We checked his credit. I gave him some good credit advice. He qualifies now. He could buy right now, but his target is next summer. And so we developed a game plan to put himself in the best spot next summer when he's ready to actually pull the trigger. But I do think talking to a lender 6 to 12 months before you're ready to do something is the right time frame because it gives you time to work on some things. His credit was fine, wasn't perfect, but I gave him some good tips and good things to work on. So hopefully when he is ready and we pull his credit improves and he gets a better loan program at the time.
Yes, and I think there's so many myths, misconceptions out there about how to improve your credit or how to correct your credit. And you might be doing the wrong thing unless you're talking to someone that actually does this every single day and knows what they're talking about.
It's exactly right. As a matter of fact, I have a family member who I met with recently, and in his mind, he thought he should pay everything off. I pulled his credit, and his credit actually took a hit because he paid everything off and closed some
Wow.
accounts, and his scores went down instead of up. And so that's why I always tell people before you start doing things that you think are going to help, make sure you talk to somebody who actually looks at credit on a daily basis.
Because I think a lot of people, something you just said, closing a credit card, you would think, yeah, that's a great idea, but not necessarily, right?
Not necessarily. If you only have 2 or 3 open active, credit cards and you close one that you've had for a long time, then the average age of your credit goes down, your available credit goes down. Um, it can be a bad thing. So very wanna be very careful about closing out accounts unless you have good credit depth and know what's going on.
Well, anything else you'd like to talk about that we haven't talked about already, or something you want to bring up, or there's some figures or facts that you think would be helpful?
Well, I was
Okay.
one other thing that I did was I wanted to show sort of the impact um, on a home. I did the same thing on the cost of waiting, and I used a $500,000
Oh,
price
wonderful.
range, right? And so
Wonderful. Okay.
I sort of showed if yeah, I'm happy. I don't know. Do I have the ability to show my screen? I'm not sure if people will be watching this. Well, they'll probably be listening to it, so that's okay.
Most of them would be listening. Yeah.
Okay, so that's fine. So a $500,000 home in 2022, the average rate in 2022 was 5.33%. because we started the year around 3, we ended the year in the 6s. So the average was 5.33. So if you put 20% down on that house that year, the monthly payment would have been about $3,400. Okay.
Okay.
You wait 1 year in 2023, that home went up by about $20,000. So now it's worth 520, and the interest rate is now 6.8%, and the monthly payment was 39.15. Okay. So about, call it 3,900, 3,400. So about $500 a month increase. In 2024, that house is now worth 540,000, and the payment's $4,000 a month. So it went up another $100. And then in 2025, now we've seen rates come down a little bit. The home's now worth 562, and the payment's 39.73. So this is a situation that people didn't buy in 24, but then they bought in 25. They gained about $40 a month on their payment, but they lost about $22,000 in equity because the home went up that much. So it's
Yeah.
always one of those things like, how much are you really gaining by waiting?
Not
The
that
bottom line,
much.
not that much, especially now that rates have sort of calmed down and we're not continuing to climb. One thing I failed to mention earlier as to why we don't expect rates to improve in a material way, most of the economists that I follow really attribute it to the fact that our government debt and our government deficit are both huge. They're very, very
Yes.
large, and they're not likely going to change much. Neither party is talking about balancing the budget. Neither party. I mean, Republicans like to talk about cutting, but their actual ability to do so has not been that great. And so the fact remains is our debt keeps going up, our deficit keeps increasing, and as a result, that's sort of just going to kind of put a floor under rates. It's going to be very difficult for rates to improve in a real material way as long as our debt and deficit are as large as they are. Um, so I would say on some level, pay attention to that as a concerned citizen. And if you start to hear things like our government all of a sudden starting to act more responsibly financially, then maybe we can start to see things improve. But as it stands right now, we do believe that that's going to make it very difficult for rates to get much better than where they are right now. So I would plan for rates to be in the high fives, the mid sixes for the foreseeable future, and hopefully inflation remains at bay. If we saw inflation come back, then we could see rates tick up again.
But we don't want that on either level, on either
We don't.
avenue.
And I think the Fed has done a good job of fighting it, and they've gotten it down to a more manageable level. It's not at 2% where they want it, but 3 is a lot better than 7, 8, and 9% inflation. So even at
Absolutely.
3%, it's much better than it was.
Well, and I know most people are historically they're not going to care about this, but I think historically, 7 to 7.5 has been the average over the years of the interest rate. So we're actually below the historical average.
That is correct. That is exactly right. And and make no mistake about it, when rates tick above 7, it really put a slowdown in the marketplace.
Yeah.
And you can probably speak to this more than I can, but this is for the first time in a long time, it appears as though it's becoming more of a buyer's market. We're starting to see more price
Starting to
reductions,
see. Mhm.
starting to see more sellers contributing to buyers' closing costs. So being able to get into a home is starting to prove to be a little bit easier because you're seeing a little flexibility on the selling side.
Absolutely, absolutely. We went to pretty much a balanced market, but I think it's leaning toward the buyer side. And yeah, it's going to make it easier for the buyers. And we're not at a point where it's really hard for the sellers either, because uh, sellers' expectations have to be adjusted as well. Because when it was such a strong seller's market, they could do anything and ask anything they wanted. Now we've got to be a little more realistic. But business is still good. So everybody's buying and selling. Just have to be
Absolutely.
smart about it.
That's
And we have
exactly
to
right.
talk to a good lender before we start buying a house.
Absolutely.
Speaking of good lenders, Chad, how do people get in touch with you?
The best way to reach me is my cell phone, 713-826-8136. That's the best way to call me. And then, of course, our website, bwclending.com. Easy to reach us there. You can apply online if you want to get pre-approved, however it works. But we welcome that opportunity. Gene, we've really enjoyed working with you over the years and love the fact that you're
Same here.
doing your best to impart wisdom out into the universe.
I'm trying. I'm trying. Also, I just wanted to say if people go on your website, they maybe, well, tell me if I'm wrong. Can they sign up for your newsletter? Because I love your weekly newsletter. Talks about interest rate. It talks about other things as well. I think it's a great newsletter.
That's a great question, actually. I don't know if we have that on there, but usually the way it works is if they go in and register on it as for me to reach out to them, that's how they make
Mhm.
it into our database. So
Okay.
anybody that
Okay.
applies with us makes it into our database, but I'm happy to add anybody who wants to receive it. That's for sure.
Okay. Well, we will have your contact information on the podcast. Uh, so thank you again. Anytime you want to come on here and talk about business, I'm happy to have you because you are just a wealth of knowledge.
Well, I appreciate that, and I'm happy to be here. Just let me know when and if you need me. Happy to help anytime.
I will. Everybody out there, please give him a call. Remember, you're not going to say anything he hasn't already heard, and he's going to be able to help you get ready.
Absolutely. Absolutely. Well, thank you very much, Gene, and you have a very happy holiday season.
You too. Safe and happy, everybody. Thank you.
Take care. Bye.
Thank you for tuning in to the Real and Real Estate Podcast. I hope today's insights have inspired and empowered you. Don't forget to subscribe, leave us a review, and share the podcast with anyone who might benefit. Have questions or a topic you'd like us to explore? We'd love to hear from you. Until next time, stay informed, stay inspired, and keep moving towards success.